Okay, so most popular question that I'm ever asked is how to calculate the value of a rental property, and I'm really bad at this camera thing. Um, and yes, every market is different. Yes, there's lots of variables, and yes, it definitely depends how you run your business. But in general, the numbers never vary. Period. And you'll see those three clips about how to calculate value. One's going to be about rentals, one's going to be about flips, one's going to be about your repair costs, and one's going to be about private lending. With your rentals, everyone has an opinion, and every opinion is valid. Everyone runs their business their own way, and your market depends a lot on how you do your numbers. But roughly, there's a few methodologies. I'm not going to go into the 2% rule and some of the more common rules of thumb because that's what they are for me. They're rules of thumb. I run the 2%. Okay, it's in the ballpark. Let's go look closer. Another one in my market, and every market has a different variable, but mine is 45,000 per thousand in gross income. If a thing makes $2,000 top line, if it's all done and beautiful, it's worth 90 grand. If they're asking 180, I'm just going to sit back and laugh and wait for them to come to their senses. But the real in-depth way to run the numbers, my real in-depth way to run the numbers, is the first thing you have is your gross income. And let's say that's $1,800 a month, $900 per side. My bedroom for my market, a 3-bedroom side-by-side double, $1,800 a month. Go down a line. I take out 33% maintenance, vacancy, management, capital expenses. That's 10% maintenance, 10% management, 10% vacancy, 10% capital expenditures. Yes, you don't know what your maintenance is going to be in a year. It might be 40%, it might be 2%. Don't know. You don't know what your vacancy is going to be in a year. Don't know. But you got to plan for something. You got to put a number in there. So for me, it's 10, 10, 10, 3. And the 3 is totally somewhat variable because it's kind of in there to make the math easier on 1,800. 1,800, take off a third, I'm at 1,200. So then out of my 1,200, that's where I take out my taxes, insurance, sewer, and whatever utilities the landlord pays, not your mortgage. So let's say, on this example, let's say all of that is $400 a month. So now I go from 18 down to 12 after taking my third off. I take off another 400, I'm at 8. So 800 is what I'm really walking out the door on. If I have no mortgage, that's going in my pocket every month safely. And if I manage myself, I get a little extra. If I maintain myself, I get a little extra. If I don't have any vacancy, I get a little extra. But I'm putting eight bills in my pocket every month on that double, 400 a door. Not bad for my market. Then you take out your mortgage. Now, when calculating value, the 800 is the one that matters. You've taken out your maintenance, vacancy management, you've taken out all your other expenses combined, and you're left with that last $800, whatever fraction that is. You take that, you multiply it by 12, so you're at $9,600. And then you divide it by, and this is where it's very variable on your market, your cap rate. My market, 10, 12, 14, 16 is where you want to be on cap rate. 16s are getting less and less likely every day. Our market's been going up quite a bit. So $9,600, if you're in a 10% cap market, $96,000 is the finished value of that home before any repairs or upgrades that are necessary to generate that $900 a month income. If it's fully rented and the units look good and it looks like what you could stick a new tenant in there at that price, then okay, fine. But if it's not, you refer to your rehab numbers and that $96,000 it'll go down. I'm not taking into account realtor costs. I'm not taking into account transfer tax or closing costs. Those to me are one-time property-related depreciable expenses or deductible expenses. I'm not looking at those things. I'm simply looking at it and saying, hey, $96,000. I'm looking at the place. It's kind of a dump. It's going to take $25,000 to make it not a dump. My now top value that the property is worth is $71,000. Whatever I can get it for below $71,000 is a win to me. Or if I'm a wholesaler, I know that my end guy has to get it for 71. So now what do I get the house for that's less than 71? People always say to me, well, the ARV is 250. What do you mean 71,000? Well, I'm a landlord. I don't eat ARV. I don't eat equity. I eat monthly cash flow. So if you're in a market that's appreciating reasonably comfortably or excitingly, then you might say, yeah, I'll pay 200 for something now because it's going to be worth 300 something in 2 years. That's a speculation game. I've never worked in a market that game made sense. And I don't think even if I did, I would play that game, because people played that game in 2006, and in 2008, it didn't go so well for them. And I kind of played that game myself in Jersey one time on some flips, and I'm still paying off the debt. So as a landlord, I don't care. My bank cares. My bank is going to look at it and say, hey, gee, we can give you a lot more on the loan. And I'm going to say, no, thanks. I want to take what the property can afford. So that's the quick recap. You take the rent, you take out your maintenance, vacancy management, and CapEx pads, whatever they might be. I know people that do 5, 5, 5, and 3. I know people that just do 15%. At 33, I'm one of the highest, and you'll be surprised, somebody that does a 20% pad versus somebody that does a 30% pad, that 30% off the top will lower your values by a lot. Now, if you've bought it at that, 9 times out of 10, the appraiser is going to come in and say, oh my God, this is worth more than da-da-da-da. So your chances of a cash out refi are greater. But again, I'm not doing it for that. I'm doing it because of what I'm going to make every month. Now, in another video, we'll cover the cash out refi game, because there are people that do cash out refi for every dime a property is worth, even if its monthly income will barely cover the mortgage, because that's free money. That's tax-free money that you get from the bank. I'll cover that in a different video. That's not my philosophy. This has mostly been about how to do your valuations. I hope it's helpful. Please check out my other videos. Definitely subscribe. And if you ever want to do mentorship or training, we're always here. Steve Franco, your multifamily investment specialist. 570-798-7051. Thanks.